Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Mathew. We're talking about everything related to mutual funds on this program. This is where we get you actionable insight so that you can make your investment decisions with confidence. Now, on this program, we also get you insight from the people that manage your money. And to that end, we're today joined by Rahul Singh, the CIO of equities at Tata Mutual Fund. Rahul, thanks so much for taking the time. We intend to talk about the Tata Multi-Asset Opportunities Fund because there's so much that is happening across the board on monetary policy as well as fiscal policy. There's geopolitical tensions that we have to take into account. So I thought when you talk about the strategy that you're employing in that particular fund, my viewers will get a sense of how to approach their investments as well. So let's start with that. What, according to you, are the key triggers in the near term that would affect your portfolio strategy in that particular scheme?
Thank you for having me, and good afternoon. So I think multi-asset, as the name suggests, basically plays with equity allocation, debt allocation, and commodities allocation, depending on the nature of the market and the state of the economic cycle. Today, the stage of the economic cycle is one of expansion, more so in India than in the US. So we are obviously today 65% into equities. Out of that 65%, there is some arbitrage portion, but about 55 is a long equity portion. We also have about 10% in debt, mostly in duration, slightly longer duration, because we expect the rate cycle to be on its way down over the next 1 to 2 years. And the 25% which is left is basically devoted to commodities. And that has two parts in Tata Multi-Asset Opportunities Fund. The first part is what we call as commodity arbitrage, very similar to equity arbitrage, gives us 8.5% kind of yield. And of late, in the last 6 to 12 months, we have started building in long positions in gold, also gold and silver. So today, as we stand, gold and silver would be about 6 to 7% allocation, and the rest would be commodity arbitrage earning a fixed annual return of 8.5%. Now, the reason why I think multi-asset makes sense at this point of time is not only we can vary the equity allocation in terms of the long portion downwards if the valuations keep going up, but also we have the option to de-risk the AUM by increasing the allocation into gold and silver. As you all know, there are global risks today in the market. They have not completely gone away in terms of geopolitics. I think interest rate risk is still little lesser, but in terms of geopolitics and what it could do to the environment, there is a little bit of risk there. So gold and silver does provide multi-asset opportunity and edge in terms of hedging the risk from an investor point of view. So it's an ideal, as you can see, it's an ideal mix of equities, commodities, and debt. And in all the three segments, we can vary the aggression with which we want to be present in each of these three segments. That can work out very well over the long term from an investor point of view. Okay. Especially from a risk-averse investor point.
Okay. I do want to break each of these segments to kind of understand the factors at play. On the equity side, and I'm looking at your equity portfolio, and most of the companies that you're holding, the earnings are out of the way. So from that perspective, what are you gaining or what are you learning from the print that you've seen for the third quarter? And do you anticipate that 50% of your assets under management has a decent up move in heading into the new financial year as well?
Yeah, good question. Actually, this earnings season has been by and large okay. There have been marginal surprises, positive surprises in sectors like IT and pharma so far. Banks have been mixed. Capital goods, industrial manufacturing have been quite solid. So, as is the case with most of the results season, it's been a mixed bag. But by and large, what we are seeing is at an aggregate level, Nifty 50 earning estimates for next financial year of about say 1100 rupees is not coming down. It's staying steady. It is holding on. So that is the real barometer of how the earnings season has been. I think it's been by and large fairly balanced and fairly okay. So as far as the equity portfolio is concerned, therefore, in this context, therefore, one has to take a valuation call. And what we are doing at this point of time is that with every rise, we are reducing the equity portion. So we used to be 57, 58, almost 60% net long equity. Now we are down to 55 and below. So gradually, we are also reducing the net long equity portion. And as I mentioned earlier, even within the equity portion, what we are doing is that we are reallocating some of the capital to large caps, to the mega caps, where the stocks and valuations are still reasonable, and reducing some of the risk in mid and small cap. It is not that we are negative on mid and small caps. I think the opportunity in an economic cycle like what we are in today, does favor mid and small caps over a longer period of time. But purely in the short term, I think the valuations are little rich compared to large caps. So from a risk reward perspective, I think large caps are finding slightly higher allocation today as compared to say 6 months back.
Okay. A quick question on the large cap allocation as well, because, and I think fund managers across the board have had to contend with this, heavy selling in a few names in the financial space. And I think most funds are overweight on these names. So does the conviction remain, or has that gotten shaken at all?
Well, there is a period of transition in some of the larger banks because they are, apart from their bank-specific issues, which you might be referring to, there is also a NIM pressure, which is there in a systemic level. There is a pressure of deposit mobilization. I think it's a phase which we are going through. I don't worry about it beyond a certain point because the valuations are still very, very reasonable compared to the rest of the market as well as compared to their own histories. Some of the large banks are trading at pretty reasonable multiples compared to what's happening elsewhere in the market. So that's a source of comfort. Obviously, that does not mean that we don't look at short-term pain and we don't think about it. But over a period of time, I think it kind of evens out, especially as far as banking sector is concerned, because banks at the end of the day are compounding stocks. So you might get 25% CAGR in 2 years, and the third year might be just 5% or 10%. But if you look at it on a 3-year, 5-year blocks, you will get 12 to 15% kind of compounding returns from here. And that makes us very interested on any declines from here on to add and hold on from a longer term horizon and overlooking some of the short term pain which might be there. And this is not just for multi asset, but this is generally for other categories of funds also.
Understood. This particular fund or this particular scheme allows you from a tactical perspective, and you're pointing out that you are reducing a little bit of risk on the equity side. Because you have the fixed income component in your scheme as well, and because we're likely heading into an interest rate falling scenario, from a tactical standpoint, this might just be a great idea to get into duration as well. And you mentioned that you are in duration. So from that perspective, do you hold cash? Do you increase cash, at least in the short term, or do you allocate more towards duration? What's the strategy on the fixed income side?
So the cash here is basically goes to debt. So first of all, this fund is very tightly allocated. So 65% into equities at all points of time, including arbitrage, 25%, 20 to 25% commodities, and 10 to 15% in debt. So there is very little room for cash, and you can say that the surplus cash, if at all, keeps getting added to the debt portion, which we allocate on a short-term basis. Even the short-term yields are not bad. So the cash which is temporary and transient because we may not be having equal opportunities in the commodity side is a transient cash which we do deploy in more accrual based paper. But the core allocation in debt, you are right, is what we are doing is what I mentioned in terms of holding some good duration paper there.
Okay. Last question as a base case, because we're speaking just ahead of the Fed policy, and while it's widely expected to keep policy rates unchanged, we're wondering how many cuts, if at all. Does that affect the expectation for monetary policy in India? I know the governor states very firmly and categorically that it doesn't, but then global bond yields do tend to move in tandem with the US Treasury. What is the expectation, base case?
Well, I think somewhere during the year the rate cuts will cycle will resume. It's really touch and go, and it's very difficult to predict what the Fed might do in the short term because the economy there also is giving strong enough signals for the Fed to not start cutting rates too aggressively too soon. So it's a mixed picture. I don't think we are very clear, or neither is anyone very clear on what will happen exactly in the very short term. But overall, my sense is that there will be some linkage at the same time with the global and domestic interest rate cycle. At the same time, there is also tight liquidity in the domestic scenario. So there is some requirement for the credit and the growth to be supported, the liquidity to be eased. So there are a lot of pulls and pressures, and I'm not qualified enough to give you an answer one way or the other. My sense is there will be some linkage to the global rate cycle, but not entirely.
Fair point. Hopefully, my viewers through this conversation have gotten a bit of a perspective on how you and your fund managers are managing this particular scheme and your approach, of course, across assets. That really was the objective. So thank you so much, Rahul, for taking the time and speaking to us on NDTV Profit.
Thank you very much. Pleasure.
Right, viewers, so there you have it. That was the view on the Tata Multi-Asset Opportunities Fund. We've got more lined up on this particular program in just a bit, so do stay tuned. Welcome. You're watching our special programming in the run-up to the budget. And while there's been a lot of discussions around the government's fiscal position and the potential for growth going forward,